technical market call for March 31st, the end of the quarter. We'll get right into it here. First of all, want to thank everybody in Atlanta that came to our PowerShare Summit meeting that I did for Merrill Lynch. It was a very nice meeting, and I know some of you are on this call, and I want to thank you for your participation. Okay, with that, guys, we've been looking for the market to head up into the end of the quarter and possibly into next week. So far, we're doing that, and frankly, the rally does not look particularly enticing, and we're seeing all sorts of news and hype now. The interesting thing to me was some of the IPOs coming out and doubling yesterday that we saw and that sort of thing. You know, sort of like the good old days, kind of like back in 1999. I don't think this is a peak like 99, but I do think we have the chance of getting a fairly decent correction. My monthly indicators will be overbought. Sentiment, even on the Japanese and Middle Eastern news, when we did pull down to that 126 area that we've been forecasting, we've only gotten to 23% bears here, and that is just not high enough to make a real bottom. So we are looking still for the possibility of correcting into the May-June time period and then having a very strong second half of the year. So we'd be using this rally now to sort of lighten up, take a look at positions, sell underperforming stocks, and otherwise be just a little bit more defensive and see if we can get a pullback. Obviously, guys, tops are the hardest thing to forecast in this business, much harder than bottoms are. So we're not wedded to this, and if we see a lot of improvement in the markets, we'll get very, very bullish again because we are bullish on the year. But for now, I got to look at some of these indicators and the way we're trading and say to myself, we're a little bit vulnerable. We need to be a little bit defensive here. Along with that, the bond market is trying stubbornly to hold on here. It is a short-term uptrend. Stochastics are back down into the 21 area. We're not, we'd really like to see these bonds holding above 93. We're at 92.60, so they're close. And the accumulation model suggests that we could see a bond rally coming into the next couple of months, and that is our forecast, i.e. rates down for the next couple of months and then slowly back up, ending the year about where they started. And, you know, we are rallying from there, so you got to think this may work, but I wouldn't have big bond positions. By the way, still looking, corporate bonds look much more appealing than the treasuries here, at least in terms of the ETF. The other thing is, I think that if we do enter a real rising interest rate environment for the next few years, and I think that's possible as we start to see economic strength, we need to be talking to our bond portfolio people at the firms that we're with and talk about laddering portfolios and that sort of thing. Okay, let's go look at the commodities because I think commodities also can pull back a little bit into the May-June time period. And I'll note that in spite of all the hype on these commodities that we've been seeing, our favorite broad-based commodity ETF, which is DBC, still has not exceeded the March 7th high. We're close to it, but we still have not basically exceeded that high. And that is in spite of all sorts of hoorah and everyone jumping up and down about these commodities. Gold also has not really exceeded any sorts of highs. Silver making new highs. That's actually bad for gold. We are expecting these markets to come down a little bit as well as oil. In terms of the international markets, we've got a very interesting thing going on here because on the weekly chart, the dollar may be forming a cutout low. Having the dollar make a low here is in line with some of our forecasts, especially that the dollar and commodities could rally together in the second half of the year. If we should see a situation where the dollar is rallying and commodities are rallying, we're going to need to buy commodities, especially because I think the average pundit in the news is going to be telling us that they cannot rally together when in fact they can. Realize that commodities actually can trade on their own fundamentals, and if the fundamentals of supply and demand are there for a commodity, it doesn't matter what the currencies are actually doing. So given that, commodities remain our absolute favorite sector of the market, by and large. We want to have some positions there, but realize we're going to have another chance to get in there and buy. Also, note in terms of our sector weightings, the consumer staples index has been actually doing very, very well. Staples is very close to all-time highs and has made several all-time closing highs. We would be adding money to consumer staples, and we think the reason for that, again, is foreign money has a tendency to come into those types of stocks. We note that Coca-Cola, which was recently on our list, has made new 52-week highs. We like the looks of Colgate and some of these other names in staples. I would be putting some new client money in there if you're getting new clients and you have to invest in something, sort of waiting to circle back into some of the other favored sectors. I am still thinking that technology is going to have trouble. I look at the IYW, I see it trading very badly. We'll talk about a couple of the technology stocks in the stock section. So just be warned, technology, which is the absolute Wall Street darling with 8 out of 10 strategists overweight, is actually starting to lag in quite a pronounced fashion now and may actually not do so well for the next couple of months. With that, we'll get into the stock section of the call. The first stock I